investors, I think, are finally waking up to that reality. They're finally seeing that, this money printing doesn't last forever. The sugar high doesn't last forever. I mean, don't get me wrong, it lasts as long as you keep getting more and more sugar, but that has ended, right? And one of the really scary things, again, I hate to keep going back to the 1920s, but it's a really good parallel. In the late 1920s, it didn't take the Fed raising interest rates super high and selling off a ton of the balance sheet. All it really took to burst the bubble was simply for them to stop all the new money creation. That was all you needed. Anything else was just icing on the cake in terms of ensuring a crash. But literally, all you had to do was just stop the Ponzi scheme. Ponzi scheme doesn't work if things are stagnant. It only works if that pyramid continues growing. So by shutting off that spigot, you don't even have to take anything away, and you can ensure that things are gonna that things are going to go down and in a hurry. And again, investors, I think, are waking up to that reality today. The consumer is running out of cash because they're not getting infusions anymore. We're seeing the same thing for businesses as well. They just can't keep up with the increase in input cost inflation. It's been a house of cards, and it doesn't take much to knock down a house of cards.
Welcome to the Rose Show podcast. Well, welcome to the 7th season of the House of Cards. I'm here with Dr. EJ Antoni. He's an economist, public speaker, consultant, monetary scientist, but most of all, he gives us the truth in economics. And he's a really great guy as well. So grateful to have you here, EJ. How are you doing today?
Oh, it's my pleasure. Thank you so much for having me. I'm hanging in. It's been a turbulent few days, but hanging in.
Well, so grateful that you're here. And yes, it has been a turbulent few weeks, I would say, with this yen carry trade and everything that's been going on in the world. Now, you're also a research fellow at Heritage Foundation, and we really love your work on Twitter and X, I guess we should call it. So, I want to get started with just an economic overview. And, I ask our audience to remove your goggles from the mainstream news and all the fabricated data, the economic data we have out there. And I need to ask you, Dr. EJ, is this the weakest strong economy? There's a huge disparity between the headlines and the details and all the revisions, lagging, leading indicators, soft, hard data, real and fabricated data. What are your thoughts on this?
No, I think that's a great way to put it, that this is the weakest strong economy. I mean, it really is unprecedented how we have this incredible divergence today between the headlines and the business news and the underlying data. And it's not simply a matter of there's a ton of media spin. I get that, but we've had that before, right? That doesn't quite explain everything here. There are a lot of problems with things like statistical models that are being used at the Bureau of Labor Statistics, for example, the BLS. And it's to the point now where we're, I think, bordering on willful negligence. What I mean by that is, in the past, when they had statistical problems with their models, they were pretty quick to fix it. Maybe not quick enough for some people. I totally get that. But we're going on several years now of essentially garbage outputs from some of their models. And at some point, you have to wonder, how is it everyone else but them can see it? Or is it they see it and they just don't care? Or do they purposely not want to fix it? One example is, you mentioned revisions. Well, we had huge revisions last year to the jobs report. We also had huge revisions during the Great Recession. We forget how quickly the labor market was falling apart in 2007, 8, and 9. And you have to go that far back to find a period when you had revisions that were worse than what we've seen recently with these jobs numbers. And the reason for that was because assumptions that the BLS had previously made about the labor market didn't make sense anymore. For example, one of those assumptions is that when one firm fails, goes out of business, they just automatically assume a new one takes its place, because they can't survey every business every month, and they don't want to survey brand new businesses because that gives you essentially a warped view of the labor market. So they have to make all these assumptions about businesses that are starting up, as well as firms that are going out of business. Well, those assumptions don't make any sense when the economy is moving rapidly in one direction or another, whether it's expansion or contraction. And so they had to make massive downward revisions and also huge downward annual benchmark revisions sometime into the future during the Great Recession, again, because the economy was just moving much faster than they could track it. So fast forward to today, you're essentially in the same boat, right? You have an economy that is deteriorating pretty rapidly, except it's been going on for a while now. And you have to wonder, why on earth are the pencil pushers at this point? Why are they not adjusting? Why are they not looking around and seeing there's clearly something wrong here and doing something about it? And you can make all the assumptions you want about how the bureaucrats are trying to help the Biden administration, whatever the case may be. But even if we just stick with the facts, assumptions aside for a second, there is clearly something wrong with the numbers. They don't make sense.
The numbers do not make sense, and there's significant discrepancies. And that's how I want to break it down for everyone here today. And you are the perfect one to do this. The GDP, I mean, it just came out today. I believe the estimate's even higher than they anticipated. I think it came out at 2.9 versus 2.5. Here we're getting this strong GDP number.
Mm-hmm.
However, if we look beneath the hood, we see that the fiscal spending is bloating that number. And it's actually disguising, in my opinion, a private sector, not only hardship, but recession. So I want to ask you, EJ, are we in a stealth recession? Are we in a recession with all this data, with the discrepancies, and I even say manipulated data, just used to cover it up and smooth the Fed's economic cycles? Is this what we're in? Are we in a recession?
I would not be surprised if, when the recession is eventually backdated, that they say it began in July or this month of August. I genuinely would not. It would not surprise me in the least. I just saw a survey, for example, that shows that half of families, this is scary and sad, but half of families right now preparing to do back to school shopping can't afford it. In other words, they literally don't even have enough cash to buy crayons and notebooks for their kids. So they're going to have to put it on a credit card, and they're not going to be able to pay it off. So it's just going to get rolled into the balance, which means more interest. I mean, families are already paying, think of this, $250 billion a year just in interest on credit cards. That's not putting a dime towards paying those cards down. That's literally just the finance charges. It's a great parallel to what's going on with the national debt, where we're paying over $1 trillion a year right now just in interest. And actually, that's another great example of the statistical manipulation, whether it's the Treasury Department or the Office of Management and Budget, the Congressional Budget Office, any of those. They love to use a made-up category called net interest, which essentially is the actual interest on the debt, and then they subtract out all these different revenue streams to the Treasury. So instead of getting about 1.1 or $1.2 trillion, which is the current annualized rate for interest on the debt, you get about $800 billion. That's a pretty big disparity. And again, it's because they are manipulating the numbers and literally making up a brand new category. But all that aside, sorry for the tangent, you go back to how bad families have it right now, and just how bad the cost of living crisis is today. I mean, Hershey's just had a horrible earning call because people can't even afford chocolate bars today. It is absolutely atrocious. And you look at things like CPI, which doesn't even, they don't even calculate for home prices. I mean, it's absurd. You look at home prices and interest rates, and you see what it takes to afford a monthly mortgage payment today on a median price home versus just 3.5 years ago. And then you look at things like regulatory costs, which are also purposely excluded from the CPI. People don't realize that, but if the federal government imposes a regulation, let's say it increases the cost of an automobile by $5,000, that doesn't get counted. It literally doesn't show up anywhere in the consumer price index. And so once you factor in things like regulatory costs, actual housing costs, just take those two things alone, you end up with a CPI today that's not, it doesn't have a three handle, it's double digits, it's over 10%. Easy. And that's before you start, including a bunch of other things. So, all that to say, the consumer is extremely strapped right now. The amount of consumer spending in real terms, in other words, the actual amount of goods and services people are buying, not the prices, but what's actually being purchased, that's been going down. If you just look at what individuals are spending of their own money. Now, one of the things that's been happening with those GDP numbers you mentioned is that not only have we seen a very fast rate of growth in government purchases, but also a very fast rate of growth in government transfers. And those two together broadly make up government spending as a whole. But a lot of times we talk about government spending in the GDP numbers, but that's really a misnomer. That's being used to only describe government purchases. So think of that as the government's going to go pave a road outside, and so they buy asphalt or concrete, whatever the case may be. That goes under government purchases. But when I take your money and I go give it to someone else, that's a government transfer. And when that other person spends your money that I took from you, it doesn't get counted as government spending. It gets counted as consumer spending. So a huge portion of even the consumer spending growth that we're seeing today is really facilitated, again, by government. So you subtract all of that out, all that government activity, and you find consumer spending going down, not up. I mean, there's a reason why polling on the economy is so terrible. And by the way, I'm not just talking about polling in terms of approval ratings for Biden or Harris or Congress, whatever the case may be. I'm talking about how people feel in terms of their own personal finances regarding the economy, no politician involved. The numbers are terrible, and they don't match these blowout GDP numbers that we keep getting. It's because the numbers, again, just don't make sense. They're not reflective of reality.
Like your colleague, Dr. Peter St. Onge says, they're gaslighting the public. I feel these numbers are just, people know how they feel. Like you said, prices are higher. It's much harder than we had it even just a few years ago. It's getting worse. And then they're giving us these numbers that make us question, maybe it's us. Maybe it's, what is it? What's wrong with me? Maybe it's just me. When people need to realize these numbers are fake and they're fabricated to fit their narratives. So I appreciate you telling us about this government transfer. That's significant. So it's not only the spending, but it's the transfer. It's making it that it's really consumer spending, but it's not. It's government transfer. That's a big, excellent point that you brought up there. Thank you for that. In your tweet, I think just today, you wrote about the outstanding credit card balances and the auto loans, which are at record highs. We see delinquencies increasing, and we have higher prices, higher cost of money. It's getting really hard for people. And then that's the private side. Then we have the public debt. We see the government spending to no end. We have 35 trillion increasing plus, and then the interest expense over $1 trillion. Now, this isn't sustainable. You and I know that. But how much further can they actually kick this can?
Unfortunately, it's very difficult to answer that because it's not so much based on math. It's based much more on psychology, actually. What I mean by that is it's very clear if you look at the math, as you just said, this isn't sustainable. This can't last forever. And arguably, we're already at the point where we should be facing much more serious consequences, but we're not. Why? Because people are still willing to buy government bonds. Why on earth? I don't know. I wouldn't touch them with a 39.5-foot pole. I don't have a single bond in my entire portfolio, not just sovereign debt. I'm talking even municipal debt or commercial paper. I think you're just asking for trouble. There's way too much risk, whether it's on the interest rate side or the inflation side. But a lot of people don't have that mindset. They still think of things like sovereign debt, particularly U.S. Treasury bonds. They still view that as a risk-free asset. It's insane, but that's where we are. We're still stuck in that mindset. And I think until that changes, the Ponzi scheme can go on. But as soon as that does change, it's very much like when you get these massive stock market moves. It's as if there's some kind of outside stimulus that no one can identify, which causes an entire school of fish to instantly change direction at once. And the entire mass just all of a sudden goes somewhere else. We saw that most famously in October of 1929, when all of a sudden, the rally literally just ended on a dime. And it was very, very difficult to explain. And a lot of scholarship has been done on that, but no one can really, I think, definitively pinpoint a particular piece of news or a particular earnings report, whatever the case may be. There's nothing specific that lit that match, or there's no specific match, I should say, that lit that fuse. And so I think we're in the exact same position today, where you don't know at what point the overall the overall mindset of investors is going to change. You don't know where that turning point is in terms of mass psychology. And so I understand that in finance, if you're early, you're wrong. I respect that, but I'm still not willing to take the risk of being on the wrong side of that trade.
Oh, I mean, I think that the goal is to depreciate these bonds, is to have them lower in value. Unlike the
Mm-hmm.
years of 1950s to like 2006, it was a different time then. And people are still have that bias in their mind, and they keep thinking that bonds are the way, but they're actually trying to reduce that value of the bond. So to me, sovereign
Yeah.
bonds are probably like the riskiest asset to own. And that's my opinion. But I agree with you. I don't hold any of that. I want to talk about inflation. Okay, that's another way that we're being gaslighted, because here they are printing the CPI number. It keeps coming down. This past month, month over month, was actually a negative number, which is surprising. We haven't seen that in a while. However, like you said earlier, there's different, it's in how they calculate, and they're not including these important parts that should be included that affect us day to day. So in my opinion, you can look at the true inflation, and if you look at it, the compound, the aggregate since 2020, they look at it, it looks like it's in the 20s. I mean, it's so high. Then
Mm-hmm.
you
Mm-hmm.
look at shadow inflation, and that is more than double the current print. What is the motivation, you think, behind this obscuring of this number? Why do they want us to believe it's lower than it actually is?
Well, they want to blame other people for their failures, right? They want to be able to say it's not our fault and our spending that caused the massive cost of living increase, that caused the current cost of living crisis. Frankly, they want to be able to cast blame on others. But the problem is, if the population can, in their minds, connect the runaway spending with the runaway increase in prices, then the jig is up. That's the end of the line for those politicians. It's amazing how the American population used to be, not that long ago, the most monetarily literate people literally in the entire world. I mean, this was really the only place where you had so many presidential campaigns run on issues like, should we have a central bank or not? Should banks be state chartered or should they be private corporations? Should we have a monetary system backed by gold or silver or both? I mean, these were seriously, hotly debated issues in the United States, and those were debates that didn't exist anywhere else in the world, at least not to the extent they did here. What money is and how it works used to be something that the average Joe, the typical farmer, understood, and understood very, very well in this country. And I largely blame the dumbing down of the American education system for completely eroding that over the last 100 years or so, to the point now where Americans have no idea about their monetary history, let alone any kind of monetary schema or what we should be doing differently today. So I guess that's a bit of a tangent, but I think it goes back to the idea that the American people, if they could connect all of the terrible personal finance conditions that they face today with all of the terrible federal finance policy decisions that have been made over the last several years, they would be up in arms and ready to revolt. But instead, we have a mainstream media that's constantly telling us, supply chains, right? Or greedy corporations, whatever the case may be.
Mm-hmm.
And the crazy thing is that even the Biden administration's own data shows that that's just hogwash, right? Like prices paid by businesses have gone up just as much as prices paid by consumers. In fact, for a while there, they were eating a lot of cost increases in order to try to maintain market share. It's one of the reasons why a lot of earnings were so bad in 2022. But whatever the case, the only thing that can devalue the dollar is increasing the supply of it too quickly. And the only people who can do that are at the Federal Reserve. And that's where we need to lay the blame. And the only reason the Fed does that is to pay for all the spending of the politicians that keep them in power.
The Fed has their way of creating money, and that will reduce, increasing the M2 money supply into the system will reduce the value of the currency. And I believe, monetarianism, and Milton Friedman said it best, inflation is always and everywhere a monetary phenomenon. And so exactly agree completely. Small business sentiment is very pessimistic, very low sentiment. Manufacturing's been in contraction. New orders, leading indicator, has been contracting. To me, that's a big sign right there. Manufacturing is in a recession, and I can tell you it is from our business as well in manufacturing. Labor markets, we're going to get into that. Clear signs. We have the SAM rule being triggered now. We see that. It's pretty obvious, and it's the data is breaking through now. So inflation, my last question on this, they keep showing that it's coming down. However,
Mm-hmm.
we know that the money has to come from somewhere with all this spending that's going on, all this debt. So do you believe we may be in for a secularly inflationary period upcoming, and that inflation may actually start trickling up again?
I think so. Look, there's no way out of this mess at this point, unfortunately, other than what you were saying earlier, to basically inflate away the value of the debt. There's just no appetite for any kind of spending cuts. And I think if you compare real versus nominal projections for the rest of the decade, that really becomes clear. Where if things continue on the track that they are, and look, we have an election coming up in November, so who the heck knows if things are going to continue on the track they're on right now. But let's say theoretically they do. We're going to hit almost $3 trillion at an annualized rate, interest on the debt, by the fourth quarter of 2030. So that puts in perspective just how quickly the nominal payments on the debt are going up. But again, if we continue all the current trends, whether it's growth, inflation, government spending, you name it, let's just, continue all of those in real terms, the interest payments on the debt at an annualized rate will have not quite doubled. In other words, it'll be just under $2 trillion. Right now, it's at about $1.1 trillion. But in real terms, it'll be just under 2 trillion. So again, it puts in perspective just how much of an impact inflating away the real value of the debt can have here. And that has been the mechanism by which the government has taxed the American people, has robbed them of their savings, of their income, et cetera. And by the way, a key benefit for government has to do with equity markets in this regard, in that you get these stock market booms like we've seen over the last couple of years that have been essentially almost entirely inflation, right? You look at the Dow or the S&P, somewhere between 70 and 80% of the increase right now has just been inflation over the last 3.5 years, as opposed to an increase in the real value of these companies, of the underlying asset. So you're not taxed on just the real increase with cap gains. You're taxed on all of the nominal increase. So inflation is a hidden tax to begin with, and then they're going to use it to boost cap gain proceeds, cap gain revenue. I mean, it's insane. It's just yet another layer, I guess you could say, to the Ponzi scheme. But all that to say, I agree with you 100% that I think the play from here on out is going to be to continue inflation as much as the American people are willing to tolerate. And I don't see us getting back to 2% anytime soon. 3% is the new normal. It should be zero, but 3% is the new normal.
Yes. There's been a lot of writings about that, that 3% is the new 2%. So I think we might have to, I think at some point, 3% may even be a great number compared to what other numbers are coming our way. Like you said, very well said, very rich valuations in the market. And these asset prices are higher because of the inflation. It's like the everything bubble has just been forming bigger and bigger. And we're like, when is it going to finally burst? And we're seeing little signs of weakness like we did yesterday in the market. That was a maximum fear Monday morning in the market because of the yen carry trade and a lot in the jobs market last week. So I want to go right into the jobs market, the labor market. Mm-hmm. And you have been on top of this, bringing us truth about what's really going on in this market. And you told us how there's a huge disparity in the labor reports. Last year, Q4 2023, were not only wildly overestimated, but those job numbers, half of them were actually fake. That is huge news. Please tell us about that.
Well, these monthly jobs reports are basically coming from survey data where, although the survey includes about 670,000 establishments, the actual number that are surveyed in any given month is going to be less than 200,000. So that gives you an idea of just how much data they're relying on to get an estimate for the economy, the economy-wide jobs numbers. Conversely, you can look at the quarterly census data that covers 90-something% of all jobs, right? And what do we find there? We find that the estimates are wildly off. In other words, the survey estimates are wildly off compared to the census estimates. And again, the census should be way more accurate because instead of including like 10 or 11%, you're including 95%. So which would you trust more? What we're finding time after time, quarter after quarter, is that the jobs numbers that we get on a month-to-month basis have just been nowhere near what's really happening in the economy. And unfortunately, the census data, because it is a census, it takes a lot longer to do it. It takes a lot longer to aggregate the numbers and to publish, disseminate, et cetera. So it's not timely. So I understand that you can't usually rely on it in the same way you can the monthly numbers to get the data out as fast as possible. But going back to how we opened the conversation, when you're dealing with statistical models that, for whatever reason, are wildly out of date, I'm sorry, but you really have to question the numbers that you get quickly and wait for the more accurate numbers to come later. Another really good example of this, I think, are the business formation statistics, where if you look at a chart of this, I mean, it's just insane. But during COVID, a ton of mom and pop shops went out of business. They all closed. Why? Because it was literally illegal for them to open. Oh, but you could go to Home Depot, you could go to Costco, you could shop all you wanted on Amazon. That was totally fine, right? You could go to the big box stores, you could go to Walmart, but heaven forbid you go to your local hardware store or your local florist, whatever the case may be. So a ton of those businesses closed. In response, as soon as the economy started opening, which in some states, like, in the Dakotas, for example, in Nebraska, that was by like the summer of 2020, they were open and ready for business. There was this massive surge in business applications. And then that even extended, throughout the economy as you got to the end of 2020 and then into 2021. And by the end of 2021, every state at that point was essentially fully open. So there's this massive surge in terms of the number of business applications. However, that's used as a projection for the number of businesses that will ultimately be formed. And you can look at the projection for business formation. It goes through the roof and stays very elevated all the way up to today, except that if you then overlay on top of that actual business startups, in other words, not just the projection, but businesses that actually were successful and actually opened, actually started hiring people, all of a sudden that spike is completely gone. Like, it literally just stays flat. In other words, it's all been basically a big bag of hope. They assumed that a huge portion of these businesses where people filed applications were actually going to be able to successfully start. And that just hasn't been the case. And again, there's a lot of reasons for that. There are a lot of ways you can say in which the economy has drastically changed in a post-COVID world compared to 2019. I totally understand that. But then you need to account for that, right? You need to change your statistical models and your other methodologies so that you're not relying on assumptions that don't make sense in a post-COVID world. And the really scary thing is that there's a lot of other government data that are based off of things like the business formation statistics. And now, because it is essentially like about a 2-year lag, now you're seeing other data revised wildly downward because that massive spike that we assumed happened never took place.
They assume too much. And I have to tell you, I'm in the manufacturing business. I'm actually CEO of a manufacturing company. I'm going to be giving a talk later this week about it because the truth and what's really going on is vastly different than what the data shows. And I'll tell you, small businesses, it's much more sensitive to the economic cycles and the higher cost of money. They rely
Mm-hmm.
on the lending for growth, especially the startups. And you said it right, the mom and pops. I'll tell you, we've been doing this over 18 years and we sell to all type of customers and my mom and pop people are gone. Since before COVID, my customer base has changed completely. We usually sell to startups all the way to Fortune 500s. And I'm going to tell you, my customer the past 2 years has been medium-sized businesses to up. Small ones are very few. They used to be 60 to 70% of my business. Now like 10% or less. The mom and pops are gone. I don't see them.
Mm-hmm.
They've closed their
Mm-hmm.
doors and labor costs are so high. And I'm going to tell you the turnover expenses are so high because there's a big mismatch between the employer and the employee. The expectations are, there's a huge disparity there. The employees are overstating their skills. We're hiring all the time and we have a lot of turnover. And there's just so much there. But yes, you said it right. It's forever changed since COVID, and they need to change their expectations accordingly. And now all we're going to be seeing is these downward revisions, these jobs that don't exist, and all of this hope is all gone away. So those are the lagging indicators. That's the past. I want to ask you about the leading indicators because you're on the forefront of all of this. Now, looking at the claims, the openings, what are you anticipating? We just got a reading of 4.3% unemployment rate, over 0.8% from the 12-month low. That's the SAM rule being triggered right there, over 0.5% in a year.
Mm-hmm. Mm-hmm.
We supposedly are in well, we already know we're in a recession. I can tell you we are. What do you anticipate going forward? Do you think this unemployment rate may actually skyrocket much higher?
I think so, unfortunately. And part of what's keeping the unemployment rate down right now is the fact that you have over 5 million people who never returned post-COVID to the labor
Mm-hmm.
market. So there was this huge spike in people not in the labor force during 2020. And again, a lot of that was simply just a factor of it was illegal for you to go to work. So people left the labor force. Well, in literally only a month or two after the initial lockdowns, people started going back to work. And so that came way down. But what was really interesting was the fact that it came down to about 100 million people and then just stayed there. And it hasn't budged since. And so that's just one metric. There's a few other methodologies you can use to try to see how many millions of people are missing from the labor force. You can use trends in non-farm payrolls. You can use trends in the employment to population ratio, the trend in the employment level, whatever the case may be. A lot of different methodologies you can use. But at the end of the day, you get a range of somewhere between 6.9, right, and 8.2% unemployment if you were to actually count all of those people missing from the labor force. And the
Mm-hmm.
reason it's important to count them is because they don't have jobs. It's just that they're not counted as unemployed anymore because they're out of the labor market. But again, they still don't have jobs. So if you account for that huge change, again, this is yet another one of those changes where the same assumptions and statistical models, methodologies, whatever, don't make sense anymore. You need to adjust. You make that adjustment and you find an unemployment rate way higher than that official U3 unemployment rate. So, again, unfortunately, it's not good, and I think it's going to get worse. Look, you can't spend, borrow, and print trillions of dollars you don't have and expect there not to be negative consequences. And I don't know when we forgot that. But things like you mentioned new orders. That's a great leading indicator. And unfortunately, a lot of people have chosen to ignore that. And the reason being is that during COVID, during those lockdowns, you call up your supplier and you say, hey, I need X, Y, and Z, toilet paper, let's say, right? And you're told, we don't have any, and we don't even know when we're going to get it back in stock. You don't place the order. So new orders essentially evaporated. And then you call up again, you say, hey, we want some. They're like, guys, look, we still don't know when we're going to get any. So new orders stay really, really low. Finally, you get a call from your supplier and they tell you, guess what? We got it back in stock, but we don't have a lot, so we can only send you a really limited amount. Everybody panics. All these businesses order not only to make up for the current level of pent-up demand, but also what would be normal demand. And they anticipate that demand is going to stay extraordinarily high, which was not a good assumption, but they make that assumption anyway. So there's this massive surge in new orders. And it's not just manufacturing, right? You saw it in the service sector too. And what ends up happening is that level of new orders, it's only I don't know, maybe a year later. So let's say the middle of 21, maybe towards the end of 21, when new orders all of a sudden start dropping, and they start dropping really fast because people realize that that assumption they made about demand staying at those elevated levels was not a good assumption. So new orders start dropping and people panic into 2022. But then by the end of 2022, new orders continue dropping like a rock, but it looks like the economy's not slowing down. So then people make the assumption of, I guess new orders don't matter anymore. Maybe this is no longer a good leading indicator. So the problem is you shot new orders up to such an obscenely high level, and then they had to come down over time. And people started ignoring them because, again, they were coming down without a recession, but then they started dropping below trend. And then they started dropping below pre-pandemic levels. And all of a sudden, it is, you can say, okay, let's assume away the disruptions from COVID. Now this is very clearly flashing a recession indicator, and yet people have been ignoring them. And the stock market's been rallying to record high after record high. And all of a sudden, investors are starting to realize, oh, shoot, maybe water will still wet us. Maybe fire will still burn. Maybe the laws of supply and demand can't be conned after all. And so, these are still really, really important leading indicators that we need to be paying attention to. And you ignore them at your own peril, I think.
Absolutely. We need to pay attention to them. The market keeps running like everything's okay. And then when we
Mm-hmm.
look at these numbers, it's how bad, how severe will this get? We like we discussed, and I'll just highlight it. The GDP number obviously is way overinflated and it's mostly with big
Mm-hmm.
government spending, government transfers, like you said. And then we have big government. Most of these new jobs that are created are government jobs. And now
Mm-hmm.
we have
Mm-hmm.
fake jobs. These are fake numbers. They're not as many jobs as we thought. Unemployment should be double or more, like you said, about double by 8%. If you have, the labor participation rate, it's an important number to look at. It's below pre-COVID. It's like at or below pre-COVID. These people have not come back to work, and we're a gig economy now, and that's not sustainable. So we have more than double unemployment. CPI, we can just throw out that number. We know it's more than double that. High inflation, high unemployment, stagnation all across. The economy's not growing. There's the startups, the small businesses, the higher rates are choking the economy. The higher costs of money is hurting everyone, along with the higher prices. Do you think we could be in for a stagflation worse than the 1970s because of all this massive debt, which we didn't have back then?
Yeah, that's my big fear. And unfortunately, we've made the same mistakes that we made in the 1970s, but arguably we've put it on steroids because of what you just pointed out, the size of the debt. Um, the only thing I guess that makes me hopeful at this point is if we look back at the Great Depression, that was 15 years, right? It was a decade and a half. A lot of people talk about how the Great Depression ended. Sorry, this is a pet peeve of mine. The Great Depression ended with World War II. No,
Yeah.
it didn't. Like, sure, people had more money, but there was rationing, there were price and wage controls. Even if you had money to buy certain things, you weren't allowed to because of rationing. And then the things that were available were oftentimes too expensive. So like the consumer's quality of life was still really rotten during World War II, even though GDP went through the roof because of all that government spending. Ironically, then when World War II ends, GDP starts collapsing. So many of these different economic metrics are just falling like a rock. Why? Because the government spending has come down so much, except people's quality of life, their standard of living rose dramatically at the fastest rate since the 1920s. So the Great Depression was a 15-year period, and it was marked by government blunder after government blunder, public policy mistake after public policy mistake. And at any point in time, whether it was the Hoover administration or the Roosevelt administration, they could have ended the Depression if they had simply stopped making all of those self-inflicted wounds. But they didn't. And so that was why the economic crisis lasted as long as it did. The economy was never allowed to undergo its natural healing process. And so what gives me hope is that as bad as we have it today, all of our economic wounds are really self-inflicted. There's actually nothing fundamentally wrong with the underlying American economy, right? I mean, look at all of the natural resources we have. First among them is people, by the way. There is no reason why America cannot continue to be the economic superpower, aside from our government messing everything up on us. So that's I guess what gives me hope. The thing that is less of a reason for optimism again is just how deep we have dug this hole. And also the number of people, so-called economists, who are out there who are just the market has two terrible days and they're calling for rate cuts. We need an emergency meeting. The Fed needs to cut 50 basis points this week and then 100 basis points in September when they meet. Shut up. Give me a break. Artificially low rates, too low for too long, is what caused the bubble in the first place. If these people were doctors treating a cancer patient, they'd be providing opiates to try to make sure the person's not in any pain while the cancer continues growing. The patient needs chemotherapy. Yes, it's going to be ugly. Yes, it's going to be painful. The short run effects are going to be terrible. I get it. It's still what you need to do.
Yes, it goes back to Murray Rothbard. I recently read his book again. Natural healing, the economic cycles, they need to heal themselves. And this intervention can only do more harm. We need free markets, and we need markets to just heal themselves and go through these natural cycles. But they're not doing that. And they're just keeping making more policy mistakes. And that's been my take. ZERP was always bad policy. There was no benefit to that. And we are now experiencing the symptoms of that. And it takes a long time to work through, especially when they keep adding more fuel on that fire. And yeah, these emergency rate cuts, I see them all over Twitter yesterday. They're like, we have to cut immediately. And they're having discussions about that. It's really ridiculous. And I think that, people need to realize that there is a little bit of pain. We had a lot of the free money, all this money given out, low rates, money went to riskier assets. And at some point you got to pay the piper. But we've raised a whole generation of people now with these participation trophies. And, you just get something for nothing. And it's
right.
really unfortunate. And we need a reality check. So let's talk about our favorite people, the Fed. And let's add some Janet Yellen as well into that. And this group of people, the market is still pricing in, I believe, about 100 basis points to be cut before the end of this year. And I'm starting to think this is maybe politically driven, something with the election. The economy still appears strong on paper. Their numbers, of course. So I don't see any real justification for this. What are your thoughts? What do you think they will do in Jackson Hole and September in this year?
I'm confident whatever they do, it'll be a mistake, although I'm not sure exactly what that mistake is going to be. One of the things that people have to remember is that if we rewind to, I guess it was October of last year, when Powell all of a sudden started talking about rate cuts. Why did he do that? Because the yields on treasuries were going through the roof. And all he had to do was start talking about, oh yeah, rate cuts soon, 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 like no dates, nothing definitive, no metrics, just, oh, it'll happen soon, right? It'll be once we have enough progress on inflation. The most weaselly words you could possibly imagine. But what did the market do? Yields tanked. Equities went on a tear. Everyone was like, oh, great, we're going to get rate cuts right away in 2024. We still haven't gotten a single one. Except that it did what they wanted it to do. In other words, even just the speculation of impending rate cuts brought yields way, way down on treasuries. That is really the Fed's primary concern at this point. Let's be honest. There's so much pressure from Yellen on the Fed, which has essentially just become a captive of the Treasury now, the Fed has, that Powell just needs to keep the yields low enough on treasuries to keep the interest on the debt manageable. And so with a bad jobs report, with the market tanking for a couple of days, what has happened to treasury yields? They fell again in a big way. And so ironically, now it's the market's anticipation of an impending recession and therefore impending rate cuts, including maybe emergency rate cuts, that is bringing down yields and kind of doing the dirty work for Powell so that maybe he doesn't have to cut at all. Now, eventually, though, that you can only play that game for so long, right? And then eventually investors are going to say, okay, we'll believe it when we see it. And at that point, then Powell's hands are really tied, and now he has to cut and has to do it in a big way. But the from a political standpoint here, which is obviously another really big consideration, this has been a bit of a wild card regarding the Fed. What I mean by that is it was not that long ago that Biden was saying he would keep Powell in the job. In other words, give him another term in 2026. Whereas Donald Trump was saying, when I win, he's going to be one of the first people I fire. And there's not even technically a procedure for getting rid of a Fed chair, like as soon as you enter office. But Trump, of course, was like, no, I'm doing it. You're fired. and and now what's happened? All of a sudden, Trump has completely changed his tune. Now, he's not saying he's going to keep Powell, like let him, nominate him for another term, but he said in a recent interview, I would let him serve out his term. There's no reason to fire him. Uh, okay, that's a drastically different tone than what we saw before. And now we don't have Biden anymore. Now we have Kamala. Kamala, who was one of only 13 senators who voted no on Powell at the time, before she became vice president when she was in the Senate. Ironically, it's because she didn't think he would inflate enough. Apparently, 40-year high inflation just doesn't do it for her. She wants 50 or 60-year high inflation. So now I think the reason I say all that is because from Powell's perspective, previously, there was a huge incentive to cut rates hard and fast before the election to ensure his own political survival. That's not there anymore. And so, again, if the market is going to do the dirty work for you of pushing down yields on treasuries, especially if there's a flight to safety or a flight to security as investors lose confidence in equities and they start pouring into treasuries, you know what? There's a decent chance that the Fed not only does not hold an emergency meeting, but that they don't even cut in September. As crazy as that sounds right now, given the sentiment that you're seeing in the business headlines and on Twitter.
Wow. Well, that's, that brings some reality here. I mean, I've been reading that and I was thinking they really don't have the incentive. And I know, see, like you laid out, politically, they don't seem to have the incentive. And then now with the economy and the numbers, the way they look, there's really no reason. Because, if they prematurely cut, they run the risk of igniting that inflation significantly.
Mm-hmm.
And we don't want that repeat again. Although it seems inevitable, we can at least make it not as severe, because if all we need to do is lower those rates and just add more fuel to the fire. And like you said, the market is doing the job of the Fed. And that's what they want. These yields are coming down, and that's doing it. So maybe they don't cut. So now, policy mistake after policy mistake, and I believe that thoroughly. I think that they were way too slow to raise those rates. They waited for the tapering, the ending of the tapering of their asset purchases, and they just waited. They had that dual mandate. Now people are saying the next policy mistake is that they're too late to lower. So we don't know exactly what the situation will be. We'll know in hindsight. But let me ask you about the balance sheet reduction. And that's a concern to me. They've been so passive with the way they're reducing the balance sheet. And it seems to me that the rates are hurting a lot of, like in manufacturing with my customers, a lot of them aren't buying as much because of the higher cost of money to finance purchases for new equipment. And that involves growth and financing, and those rates are affecting them.
Right,
But
right.
what about if they actively lower their balance sheet? Would that be more effective in helping bring down inflation than the rate policies?
Well, they go together, right? And this is one of the reasons why reverse repos, which is essentially a way that you can lend money to a central bank. You may ask, why on earth would you lend money to a central bank? They have a money printer. It's because it's a way to soak up excess liquidity in the same way that regular repurchase agreements is a way to inject liquidity. And now it's supposed to be on a very short-term basis. But what the Fed has done is used it as a way to sterilize money. In other words, we're going to print all this money for the Treasury to spend, and then we're not going to let banks lend it out after Treasury has spent it. Now, why would we do that? It's because the Fed has learned that the initial creation of money for the Treasury to spend, yes, that's inflationary because you're creating new money. But the real inflationary impact is once the Treasury spends it and that money works its way through the banking system and multiplies. And now instead of just having created $1, you end up having created 10. But if you can manage to short circuit that second part where the money goes out into the banking system and multiplies, you get rid of 90% of the impact on inflation. That's a pretty good deal from the central banker's perspective. That's why Ben Bernanke started paying interest on excess reserves. It's because it was a way for banks to keep more money parked at the Fed. So again, they printed the money for the Treasury to spend. The Treasury spent it. It got into the banks, and then the banks just went and parked it at the Fed. So in a way, no harm, no foul. But the effect of that was to increase the interest rate that private individuals and private businesses had to pay. Now, why is that? Because they were having to compete with the Federal Reserve, who was offering them a risk-free rate of return. Whereas if I'm going to loan you money, I don't care if it's a student loan or an auto loan, a mortgage, a credit card, whatever, that has risk attached to it. Now, reverse repos essentially work exactly the same way. You are making a short-term loan, oftentimes 24 hours, it's just an overnight loan to the Fed. You're parking money there, and it's paying at this point over 5%. I think it's like 5.3%. But what that is essentially telling you is that for the Fed to maintain an interest rate floor, in other words, to not let rates drop too low, this is how much money they're having to soak up out of the marketplace. So right now, that basically tells us that given an interest rate of between what, 5.25, the balance sheet is about $300 billion too big, because that's what we can see in terms of reverse repos. Now, then you also have to factor in reserve balances, because those are abnormally high right now as well. So really the balance sheet is even more oversized than 300 billion. But let's just stick with reverse repos for a second. The rate of decrease in the balance sheet was slowed pretty drastically in June. They're still selling off MBS at the same pace, those mortgage-backed securities, but the rate of Treasury sales has really come down. And as a result, it's going to take many, many more years to get us anywhere close to pre-pandemic balance sheet levels. So the reason I bring all of this up is because in relation to your customers who are trying to get credit so that they can operate their business, it's really being hampered not just by the size of the balance sheet or by the level of interest rates, but the mismatch between the two and all of the manipulations that the Fed is doing behind the scenes in order, again, to allocate capital to the Treasury by sucking it out of the private market. And for small business, this and medium-sized business, this is really, really detrimental. For
Mm-hmm.
big businesses, not so much, right? You have, I mean, let's face it, you have a couple of corporations today that are just as well capitalized as banks. That's how much they have in retained earnings right now. So they don't really care that interest rates are 5%. They're doing just fine. A lot of them actually, they still have loans below 1% from 2020, right? I mean, why on earth did Apple, again, who's was better capitalized than pretty much any bank, why in 2020 did they go and take out hundreds of billions of dollars in loans? Because the interest rate was lower than their dividends. So they could buy back their own stock and get paid through the dividends more than they were paying in interest on the loan that they used to buy that stock. So they literally just made money at taxpayer expense. It's insane, but that's what we did. And today, those big corporations are also benefiting just in a different way, in that their competition is getting crushed by 5% interest rates, and they're not paying a dime because, again, they're using their massive pool of retained earnings.
Yes, exactly. That's exposing the reality of what really goes on. These large corporations, that inflation helps and benefits the haves and the ones that have all this, the cash generators, and they got their money cheap and now they have the cash and they're the ones lending it out at these high rates. So they're able to make that money. And the little guys, the mom and pops, the small businesses, it's really hard for them. A lot of them are closing their doors. And these big corporations are taking over, gobbling them all up, oligopolies and monopolies. And we see what's going
Mm-hmm.
on. We just need to
Mm-hmm.
open up our eyes. It's like a money merry-go-round. This money just goes around and goes around, and it benefits the ones closest to the printer. And those are the recipients of this new money that's being created. You have this great tweet chart with the reverse repurchase agreements. And you show how they're down to the lowest level since May 21. That's
Mm-hmm.
significant. Is the liquidity party over?
I think so. And again, investors, I think, are finally waking up to that reality. They're finally seeing that, this money printing doesn't last forever. The sugar high doesn't last forever. I mean, don't get me wrong, it lasts as long as you keep getting more and more sugar, but that has ended, right? And one of the really scary things, again, I hate to keep going back to the 1920s, but it's a really good parallel. In the late 1920s, it didn't take the Fed raising interest rates super high and selling off a ton of the balance sheet. All it really took to burst the bubble was simply for them to stop all the new money creation. That was all you needed. Anything else was just icing on the cake in terms of ensuring a crash. But literally, all you had to do was just stop the Ponzi scheme. Ponzi scheme doesn't work if things are stagnant. It only works if that pyramid continues growing. So by shutting off that spigot, you don't even have to take anything away, and you can ensure that things are going to go down and in a hurry. And again, investors, I think, are waking up to that reality today. The consumer is running out of cash because they're not getting infusions anymore. We're seeing the same thing for businesses as well. They just can't keep up with the increase in input cost inflation. It's been a house of cards, and it doesn't take much to knock down a house of cards.
Yes, that's why this is the seventh season of the House of Cards. We also have negative real wage growth as well. Add that to the mix.
Mm-hmm,
So,
mm-hmm.
it's becoming increasingly more challenges for the consumer, for the people of this country. But like you said, I also have hope that we will be better and I know we will survive and we'll be better than ever, but it may get worse before it gets better. This has been so amazing, EJ. I love speaking with you all the time about this. I really appreciate you taking the time. Could you please tell our listeners how they can follow you and read your great articles?
Sure, sure. So the best place to follow me is going to be on X. The handle there is at real EJ Antoni. So I post analyses of all kinds of data reports that come out every single day. I have no social life so that you can, right? You can come and just get the highlights and see the pretty charts and everything without actually having to read through page after page of these reports. And by the way, I actually encourage people not to even try, because unless you're familiar with the statistical analyses and methodologies that go into these reports, you're never going to be able to understand them. That's one of the reasons why I actually feel bad for these journalism majors who work for, whether it's Bloomberg or CNBC or Fox Business, and write these just absolute asinine articles. They don't know what they're doing. It's not their fault. They don't know how to interpret these numbers. And so again, I do it so you don't have to. But then I also post all of the articles that I write. You'll see links for those as well, so you can stay up to date on all that good info too.
Thank you so much. We really appreciate you, Dr. EJ Antoni.
My pleasure. Thank you for having me again.